just recently there's been some discussion in the press around SME owners and owner-managers of one-person companies winding up their companies, putting them into voluntary liquidation and extracting the cash and assets from them, subject to a 10% rate of capital gains tax on the gain element of what they take out. Why would they be considering this? Well, driven by fears underpinned by the Office of Tax Simplification's first report on CGT reform, that there might be a linkage of capital gains tax to income tax, actually charging capital gains at income tax rates, or a removal of business assets disposal relief, or a toughening of the conditions for business assets disposal relief. So would that strategy, removing the cash ahead of such change, work? Well, yeah, if the change came in. So of course there is the uncertainty as to whether this change would happen at all. So you should only make that decision if it's right for you and your future to wind up that company and take the money out. If the change came in, then you would have been better off by accessing the relief now. But those other considerations absolutely need to be taken into account. Remember, of course, the conditions for business assets disposal relief. It needs to be your personal trading company. You need to satisfy basically the 5% test. You need to have at least 5% of the voting rights. You need to be entitled to at least 5% of the capital in the business. And the company needs to be one that is effectively trading, so it doesn't have to a substantial extent any non-trading activities. So if you do that and you've owned the shares 2 years, then on the face of it, when you wind the company up, effectively dispose of the shares, then you would be able to access business assets disposal relief. But there's a big but. Remember, in 2016, a targeted anti-avoidance rule was introduced to prevent so-called phoenixing. And that was exactly what I've just described, if it's then followed by starting up in business again. So basically, if you take your money out of the business by winding it up and then start up again, doing substantially the same thing within 2 years, you're going to have that money that you extracted, hopefully taxed at 10% CGT, not. It will be taxed as income. The conditions to be caught by that targeted anti-avoidance relief require me to pick up this iPad and read them to you. There are 4 of them. Condition A, the individual receiving the distribution, that is the money that they took out of their business, had at least 5% interest in the company immediately before winding it up. Condition B, the company was a closed company in the 2 years before winding it up. Condition C, at any time, this is the important bit, at any time within the period of 2 years, beginning with the date on which the distribution was made, the individual carries on a trade or activity which is either the same as the company was previously carrying on or very similar. The individual is a partner in a partnership which continues the company's original trade. The individual is involved with the continuation of such a trade or activity by a person connected with the individual, say their spouse, for example. And condition D, this is the subjective one and the one that some people have complained about. It's reasonable to assume that the main purpose, or one of the main purposes of the winding up of the company, is the avoidance or reduction of a charge to income tax. So that's quite a tough set of conditions. So the watchword here is take care. If you're thinking of doing this, one, it's by no means certain any changes can happen anyway. But if you're going to do it anyway, be sure it works commercially and totally bear in mind those anti-avoidance provisions. They're quite tough. And if you want to and need to carry on trading, doing the same thing after you've wound up, then you are probably going to be caught by that anti-avoidance rule. You absolutely must, if you're even considering doing this, take expert professional advice. Now, we cover all of this in a lot of detail in our Techlink bulletin on the subject.